Hey there, crypto family. Welcome back to another video where I'm bringing those daily crypto news articles. Today's article is on looking to take out a crypto loan. Here's what you need to know. Cryptocurrency-based loans have grown to be one of the most utilized decentralized finance that have emerged from the cryptoverse. Here we got a person shaking hands, making a deal. Loans based on cryptocurrencies have become a mainstay of the decentralized finance universe ever since the smart contract-based lending/borrowing platforms began offering the service to crypto users. The Ethereum network, the first blockchain that scaled the smart contract functionality, sees most of the total value locked on DeFi protocols dominated by cryptocurrency lending platforms. According to the data from DeFi Pulse, the top 4 of the 10 DeFi protocols are lending protocols that account for $37.04 billion in total value locked. Just 49% of the total value locked of the entire DeFi market on Ethereum blockchain. Ethereum leads in terms of being the most utilized blockchain for DeFi market and the total value locked on the network. Maker and Aave are the biggest players here, with a total value locked of $14.52 billion and $11.19 billion, respectively. Even on the other blockchain networks like Terra, Avalanche, Solana, BNB Chain, the adoption of the cryptocurrency-based loans has been one of the main use cases of smart contracts in the world of DeFi. There are about 138 protocols that provide crypto loan-based services to users, amounting to a total of $50.66 billion, according to the DeFi Llama. Apart from Aave and Maker, the other prominent players in this protocol category across blockchain networks are Compound, Anchor Protocol, Venus, Just2Lend, BenKey, and Solend. Johnny Yu, the CEO of crypto exchange KuCoin, talked to Cointelegraph about the choice of blockchain networks for crypto lending. He said, "I would say the ideal blockchain for loans and DeFi does not exist, as each has its own advantages. At the same time, the leadership of Ethereum is undeniable due to many factors." However, he didn't negate the possibility of the emergence of truly ideal blockchains for DeFi. Karir Nikolov, DeFi strategist at Nexo, a cryptocurrency lending platform, seconded this view. He told Cointelegraph, "The short answer is no. Most blockchains are crypto lending friendly. However, among the primary properties to watch for are liquidity and reliability, while a secondary determining factor might be network fees." Considering that the liquidity and reliability of the Ethereum platform are the highest right now due to it being the most utilized blockchain within DeFi, one could consider taking advantage of the same and making it the blockchain of choice. Now, prominent players, to start with, borrower's needs to choose between the major lending protocols on the network, such as Maker, Aave, and Compound. While there are a plethora of crypto lending platforms, in this piece, the most prominent ones are considered for the sake of ease of explaining and relatability. Cryptocurrency lending essentially enables users to borrow and lend digital assets in return for a fee or an interest. Borrowers need to deposit collateral that will instantly allow them to take a loan and use it for the objectives of their portfolio. You can take loans without any collateral, known as flash loans, on a platform like Aave. These loans need to be paid back within the same block transaction and are mainly a feature meant for developers due to the technical expertise required to execute them. Additionally, if the loan amount is not returned, plus the interest, the transaction is canceled even before it is validated. Since crypto-based loans are completely automated and simple for the average retail investor and market participants, in general, they provide an easy way to earn annual percentage yields on digital assets they are holding or even accessing cheap credit lines. One important aspect of collateralized loans is the loan to value, so LTV ratio. LTV ratio is the measurement of the loan balance in relation to the value of the collateral asset. Since cryptocurrencies are considered to be highly volatile assets, the ratio is usually on the lower end of the spectrum. Considering Aave's current loan to value for Maker is 50%. It essentially means that you can borrow only 50% of the value as a loan in relation to the collateral deposited. This concept exists to provide moving room for the value of your collateral in case it decreases. This results in a margin call, where the user is asked to replenish the collateral, If you fail to do so and the value of the collateral falls below the value of your loan or another predefined value, your funds will be sold or transferred to the lender. Now here's a diagram of a working crypto lending platform. You got the borrower lending DeFi lending platform. Let's see, repays a loan with interest, obtains the crypto loans. It's like a circle, deposits crypto assets as collateral, then they receive the collateral, and vice versa, receives funds back with interest to the lender and deposits to fiat. So there we go. The extent of the impact of the cryptocurrency-based loans reaches out of the DeFi market since it enables access to capital for individuals or entities without a credit check. This brings a mass population of people across the world that have had a bad credit history or no credit history at all. Since lending and borrowing are all driven through smart contracts, there is no real age limit for the younger generation to get involved, which is traditionally not possible through a bank due to lack of credit history. Now, considerations and risks. Since the adoption of the DeFi-based loans has now risen to such an extent that even countries like Nigeria are taking advantages of the service and El Salvador is exploring low-interest crypto loans, there are several considerations and risks that are noteworthy for investors looking to dabble in the space. The primary risk involved with crypto lending is smart contract risk, since there is a smart contract in play managing the capital and collateral within each DeFi protocol. One way this risk can be mitigated is by a robust testing process implemented by the DeFi protocols deploying these assets. The next risk you need to consider is the liquidity/liquidation risk. The liquidity threshold is a key factor here because it is defined as the percentage at which a loan is considered to be under-collateralized and thus leads to a margin call. The difference between loan to value and liquidity threshold is the safety cushion for borrowers on these platforms. For lenders, there is another additional risk related to the impermanent loss. This risk is inherent to the automated market maker, the AMM protocol. This is the loss that you incur when you provide liquidity to a lending pool and the underlying price of the deposit assets falls below the price at which they were deposited into the pool. However, this only occurs when the fees earned from the pool don't compensate for this drop in the price. Now here's a chart of the change in value due to the permanent loss. It goes up and then back down. Nikolov pointed out that another risk with DeFi lending platforms, he said that another one is bad collateral listing, which could lead to disturbances of the entire platform. So if you're not willing to take these risks, we recommend borrowing from a platform like ours that guarantees you certain protections such as insured custody and over-collateralization. There have been several instances of hacks since the increasing popularity of DeFi, including Cream Finance, Badger DAO, Compound, EasyFi, Agave, and 100 Finance. Additionally, cryptocurrency lending and borrowing platforms and users both are subject to regulatory risk. Liu mentioned that the regulatory framework on this issue has not been fully formed in any major jurisdiction, and everything is changing right before our eyes. It is necessary to separate borrowers from each other, private borrowers and companies of borrowers. Essentially, the risk highlighted makes it critical for you to exercise extreme caution when deploying your capital in crypto-based loans, either as a borrower or as a lender. Paolo Ardano, the chief technology officer of crypto exchange Bitfinex, told Cointelegraph, it is important that those participating in crypto lending on DeFi platforms be mindful of the risks in what is still a nascent field in the digital token economy. We've seen a number of high-profile security breaches that have put the funds of both borrowers and lenders at risk unless funds are secured in cold storage. There will inevitably be vulnerabilities for hackers to exploit. Now, the future of DeFi lending. Despite the risks mentioned, cryptocurrency-based lending is one of the most evolved spaces in DeFi markets and is still witnessing consistent innovation and growth in technology. It is evident that the adoption of this DeFi category is the highest among the numerous others growing in the blockchain industry. The use of decentralized identity protocols could be integrated into these platforms for the verification of users to avoid the entry of scrupulous players. Ardano spoke further on the innovation expected in DeFi loans this year, stating, "I expect to see more innovation in crypto lending, particularly in terms of the use of digital tokens and assets as collateral in loans. We're even seeing non-fungible tokens being used as collateral in loans. This will be an emerging trend this year." So yeah, DeFi lending is really starting to emerge and grow. as we continue to use it. They say mind the risks, be cautious. We're still new. People are trying to hack into it, make some steals. There have been some situations, but just be careful, do your research. But it is still growing. Like first, it's like you need to use like Bitcoin alone to secure a loan as collateral, or Ethereum, one of the top ones. But now we may be seeing a new emerging of using NFTs as a collateral to a crypto loan. So very interesting of where this can go and how the DeFi keeps growing. So great article and very knowledgeable if you're just trying to learn the crypto space, what's going on. So if you liked it, hit that thumbs up, subscribe to the channel so you don't miss a beat. And yeah, share this video with everyone. Like this was very interesting. Like I'm definitely looking into crypto loans as I grow my assets. I want to know how would you use them in a loan situation, then use it for another project or something. So yeah, it's just very, very cool. So yeah, hope you guys like this video. If so, I will see you in the next video. Peace.